Hey there, welcome to Retire Mentorship. My name is Freeman Lindy. I'm a certified financial planner and tax expert, which means I know a lot of things about a very small amount of things. But today we are talking about tax strategies. And so I have a new book coming out, Tax Saving Strategies. It comes out tomorrow, March 26th, 2026. And so we are going to discuss some of the strategies that are in this book. And if you want a deep dive into those, pick up the book, right? So if you're seeing this anytime after the 26th, it'll be available on Amazon. But let's jump right into it. 6 tax saving strategies. Again, this is coming from a certified financial planner. So I work across all financial aspects for people, specifically those getting close to or in retirement. And so when we talk about tax saving strategies, is for these people, right? These are not business tax saving strategies. These are not saving strategies for folks who are 22 coming out of college, really focused on this group of people. And we also have the tax background, so that's going to help us out a lot. So tax saving strategy number 1 is avoid bad strategies, right? At the end of the day, like it's kind of like with diet, right? If you say, hey, you eat all these good healthy things and you'll be healthy, but then you're also eating a whole bunch of just toxic poisonous foods, you're not really going to be healthy. And so it doesn't matter how many good strategies I give you if you're also doing a whole bunch of really bad strategies along the way, right? So a few of them that we want to avoid right off the bat. Number 1 would be permanent life insurance. This is a very popular product. It's sold a lot to people, and one of the big reasons that it is sold to people is because of its purported tax advantages, right? And the whole idea is that, hey, you're going to pay into this product over a certain amount of time, right? So you pay cumulatively over time. You then have this cash value that's available in there, and that's going to grow, and it's going to eventually be worth more than you pay. And you've got all this money that grows and becomes this great benefit to you, and you can pull that money out of there anytime tax-free and enjoy that. You can mitigate your taxes with it. That's great. And this whole time you also have this tax-free death benefit that grows on there as well. The problem with this strategy is that yes, you do have this cash value that you can use, but it takes 10 to 20 years to break even on that amount. And so part of the reason why you save so much taxes is because you have less money, pure and simple. And when you're out here, yes, you save taxes because you can pull this out tax-free and pay it back or just spend it down gradually. But you also pay interest on the amount that you pull out of there. And there's a whole bunch of other complications with it. And it's just generally not a great tax saving strategy or general strategy at all. And so if you're doing something just to save taxes and it's not good overall, don't do it, right? So we covered this and a whole bunch, and the other ones I covered before. We did another video on this a few weeks ago on strategies to avoid 3 terrible tax strategies. So there's a link in the description. You can go back and watch that one. Specifically, if you have any of these products or strategies, you're going to want to go do the deeper dive on that. Similar then, annuities. So number 2 would be annuities. There's a lot of people who have maybe non-annuities, there we go, who have a lot of non-retirement money, and they are sold annuities as a way to defer taxes on those. And it will push out your taxes. You don't pay any taxes on the growth of that money until you pull it out later. However, there's a lot of extra fees on those accounts. It turns it all into ordinary income tax instead of capital gains. And there's a lot of just other general issues with it. I'm not going to rehash all that again, because again, there's a link in the description. You can go and view those if you missed that one. And then number 3, which is deferral only, right? A lot of people are deferring all their taxes into the future, right? Because most of their savings that they do is all traditional 401k, traditional IRA, right? So we're here on the timeline, and you are just pushing out all your taxes into the future. And you know what that means? It means that for many people, right, constantly doing their 401ks, there's so many people that I meet, they got $1 million in their 401k and it's all pre-tax. They got $2 million and it's 90% pre-tax. All you're doing is you are then building up this giant amount of taxes that becomes a tax tsunami that is coming at you. And that tax tsunami hits most people right about the time they hit their required minimum distribution age, which would be, I'm not seeing that, it's out of picture, but 73 or 75, depending on how old you are. When you hit that age, for many people, they now have to pull out more out of their 401ks than they ever wanted to, and they're paying way more in taxes than they ever wanted to. And so if you're listening to your CPA and they say, hey, throw more money in an IRA, put more money in your 401k, defer those taxes because you can save it now. Just doing that without any kind of plan is a bad plan. And so that would be a terrible tax strategy. Again, watch the other video if you want to learn more about that, or it is chapter 3 in this book here when that comes out. So that leads us to tax strategy number 2. Whoops. Which is to do Roth conversions, right? If we have, so 2 Roth conversions, which is that if we have all that tax tsunami coming at us, right? All that taxes that are eventually going to come due, we've got this big IRA, and eventually we're going to have to pull taxes out, right? It was all the money that went in there was pre-tax. And then eventually when we pay that out, we're going to pay taxes on it, right? And for a lot of people, they don't need all the money that comes out. So they're going to pull that money out, and then they're just going to take all that extra money, and they're going to send that right over, and they're just going to have to reinvest that in a brokerage account, where now that money gets taxed on the dividends, it gets taxed on the interest, and it gets taxed on the appreciation, the growth as it earns. So it gets triple taxed, which is maybe not great. And so instead of waiting around and reactively needing to pull this money out and then reinvest in a brokerage account, the better strategy, of course, would be to do Roth conversions, where you say, hey, I'm going to proactively take money out of my IRA, put it into my Roth. I will pay the tax when it comes out, but from then on, it will grow tax deferred and comes out tax free, right? And so it's a much better overall strategy. And so for most people, it's not about should I do Roth conversions or not. It's how much should we do in Roth conversions, at what time, and for how long. Those are the questions that good tax planning answers, and those are the ones that you're going to want to answer for yourselves, right? And so I'd much rather do conversions than withdraw and reinvest. And all that, what we can do then is the more you do in Roth conversions, not only do we turn taxable money into tax-free money that grows tax-free forever, but you are also, as you are converting this down and lowering this balance, well, now if you have this much in the account instead of this much, your RMDs, required minimum distributions, are much smaller and probably not going to be a tax tsunami for you anymore. It's probably going to be the amount that you actually want to take out, right? So that all goes into the equation and all something that you're going to want to do to save on taxes. So again, we also did a whole video on this, to Roth or not to Roth. It's also a whole chapter in this book if you would rather explore it that way. And so it dives much deeper into how you do this, why you do this, the reasons behind it, all of that, and you're going to want to check that out as well. So tax saving strategy number 2 is Roth conversions. Okay, so the next one then is going to be brokerage strategies. And we covered this last week. But if you've got a whole bunch of brokerage accounts, brokerage strategies. If you have a whole bunch of non-retirement accounts, right, there's a bunch of things that you can do in those accounts that can make it more tax advantageous. I'll cover just a couple, right? Here's a question for you. Would you rather pay 12% in taxes or 0% in taxes? Or how about this one? Would you rather pay 22% in taxes or 15% in taxes? Obviously, you'd rather pay these. No, just kidding. You'd rather pay these ones and not these ones. And the way that you do that, right, is you say, hey, we can, as we invest in our brokerage accounts, and as that account goes down, and maybe we bought stuff here, right, and the market is temporarily down here, right? So this right here is called our cost basis. This is a word you absolutely need to know, our phrase. And if it's below what we paid for it, you currently have a loss, right? And what we would do is we would sell at this loss, and then we would buy something else that's also down in value, so that when that comes back up, right, now you've got all the gaining in. We don't want to take losses for the sake of taking losses, but if you can move from one account that's temporarily down into another account that's temporarily down and ride that back up for the recovery, you can maintain your overall amount of money that you have, plus or minus, but now you've got a tax loss for that year. It's called tax loss harvesting, right? You've probably heard the term before. Maybe you already know this one. But that tax loss, you can roll against your ordinary income, and maybe you're in the 12% tax bracket or the 22 or the 24, right? And either way, we can say, hey, we're going to deduct these losses against this income. Now, eventually this is going to grow back, and when we sell it, we will pay capital gains tax, but that's going to be either at 0 or 15, right? And so if you wrote it off against 12, then you're probably paying 0% on it later. Or if you wrote it off against 22 or 24, you're probably paying 15% on it later. Either way, you're both deferring those taxes and paying them at a lower rate, right? Now, you can only write off $3,000 a year. So if you take like a $12,000 loss on here, you're going to have to write that off over 4 years. But still, it all counts. And it's not, none of these things are going to eliminate your taxes overall, right? It's what are all the incremental strategies we can do that allow us to reduce taxes overall. All right, so that's just one. The other one, we did a whole video on this too. You can check it out. I think we linked it in the description already. So if you have a big brokerage account, big non-retirement account, then you'll want to view that whole video and watch all of it. It's definitely worth your time. One of the other ones we talked about is just controlling kind of the different things you have in there, right? Controlling what type of dividends you have. Are they ordinary or qualified? Doing dividends versus appreciation, some of those kind of things. So we had a bunch of other strategies in that video. You can check that out. Or again, there's a whole chapter dedicated to brokerage accounts in this book. Again, focusing kind of on that. If you're over age 50, getting close to retirement, things like that. You're definitely going to want to know all those things, or just pay extra taxes. Either one. Okay, so strategy number 4 would be Social Security tax planning, right? And the main thing about this, right, is, most people are going to have Social Security at some point in their life, right? You work 40 credits, 40 quarters out of a year. It's 10 years basically of working. You're going to be eligible for Social Security. If you're married, you both have it, etc. And the way Social Security is taxed is based on your provisional income, which is basically 1/2 of your Social Security plus, we'll just call it everything else. It's not quite, there's some specific things in there, but some of it. And so the way, and if this is then there's 2 different thresholds. Basically, you've got kind of tier 1 and tier 2. And if your provisional income is above tier 1, then up to 50% of your Social Security is included in your taxable income. If it's below this, if you're down here, you don't pay taxes on any of it. It's literally not taxable at all. If you're in that camp, if your Social Security is not taxable and you're both claiming it, you're probably just not paying any taxes. You're probably low enough to pay nothing. But if you go over this, then 50% of it's going to be taxable. And if you go into the next tier, then up to 85% of it's going to be taxable. But this is it's not a cliff. Like the moment you start getting into this, it doesn't turn all of it into 85%. It does start climbing. But there's this weird thing where if over time, if you say, hey, this is your tax percentage, your tax rate, and this is the dollars that you earn, right? There's this weird thing where the normal tax rates for most people will go, hey, you can earn, $30,000, $40,000, somewhere like that, and pay nothing in taxes. You paid 0% in taxes. And then at some point, right, you're going to hit the 10% rate, and then the 12% rate. So that goes up a little bit, and then the 22% tax bracket, et cetera, as you go up here, right? But then there's these things that we call the effective tax rate, which is what you'll actually see is that as you go up in income, suddenly you actually pay like 18% in taxes. And then it'll come down, you'll pay 22 for a while, but then instead of hitting 22% here, you actually hit like 25% here. And you're like, how is that possible? Well, because each dollar you earn as you continue to go up in income, whether you're doing Roth conversions or you just earn a bonus or you take an extra IRA distribution, whatever it is, right? At some point, as you go up $1,000 here, you turn more of your Social Security money taxable. And so since you're paying, you pay 12% here on the $1,000 that you make, but you also turn a bunch more of your Social Security taxable. You make 12,000 of that more taxable. So you're paying double. You're paying 24%, both 12% on the IRA distribution you took and 12% on the Social Security income you now made taxable. Does that make sense? So it's way easier to look at it with your information than when we've got your stuff in it, which we can always do. If you ever want to do a one-on-one tax planning strategy session, we'd love to do that with you. But basically, there's a whole bunch of planning then that comes into this of when you claim Social Security, what other kind of income do you have? What is our provisional income going to be? Should we delay Social Security? And so most people look at the Social Security claiming as just a purely longevity thing. Like, hey, how long do you think you're going to live? If you claim it at 62 versus 70, when's the break-even point for when you'll have more money? Therefore, you should claim it at 70. And no, really, you want to look at it holistically and say, hey, how much in taxes are we going to pay on this? How does it incorporate with everything else that we have? What are some of the levers we can pull ahead of time? And all of that, again, I want to stress, you have to do tax planning for this. You need to know what you're going to pay ahead of time so that you can plan for it and not get absolutely hammered in taxes. And so really, you want to understand how Social Security is taxed, and then you want to map it out and say, hey, if we do all these other things, what are we going to have? And if you're doing Roth conversions, all that other stuff, right? You want to know how it affects Social Security. And because again, you might say, well, hey, look, we're going to be here. And so we can convert all the way up to the top of the 12% tax bracket. And it's going to be great. When really you should have stopped here because you're paying, 25.8% effective marginal tax rate on that additional withdrawal, which doesn't make sense to pay 25% now to avoid paying 22% later, right? That doesn't make any sense. So all that to say, you really want to know how all this works together. You can certainly calculate it yourself. This has, again, more information on how to figure that out, some of the strategies involved in that, or you can work with a certified financial planner who also has a tax designation and understands how to do all that stuff. So that is number 4, Social Security tax planning, absolutely critical if you want to pay less taxes over time. And let's go on to our 5th strategy, which is charitable gifting strategies. If you are like many people and you realize that you were a saver your whole life, now you have all this money and you got to start spending it, but you can't think of anything to spend it on because you can't just turn off that savings gene that you've built up, that savings muscle you've built up over the last 30 years, 40 years. You might realize like, hey, we got to give some of this away. And I don't know if our kids need all of it. Maybe we want to give more charitably. How do we do that efficiently? 2 things that I'll mention real quick. Again, more in the book. I think we did did we do a video on this one? We did a video on this one. That's also in the description if you want more information on it. So real quick, just to whet your appetite. Again, if we go back to we have IRAs. IRA. When money comes out of there, we pay taxes on that, right? Eventually, you're going to have your required minimum distribution. That's at age 73 or 75. Basically, if you're born in 1950s, it's 73, 1960s or later, it is 75. Is the easiest way to think about that. And it was younger if you were much older, but they switched it, and that's kind of how it is now. Okay, so you're gonna have that RMD. They're gonna say, hey, you have to take X amount out of your IRA based on the balance that's in there. Well, one of the things you can do is you can say, well, instead of pulling that out to your bank where you're going to pay taxes on that, we can instead send that straight to a charity, a little church there, and that's called a qualified charitable distribution. And if you send it to a charity, it never hits yours, so it doesn't come to your bank and then you give it to the charity. It's literally made out straight to the charity. Only they can cash it. And if you send it to them, you don't pay any taxes on it because it doesn't come to you. And charities don't pay taxes, right? So they don't pay anything either. And so no one pays any taxes, and it's great. And a qualified charitable distribution will satisfy your RMD. Critically, going back to our Roth conversions don't satisfy your RMD. If you need to take a required minimum distribution, you must take that before doing any conversions. But qualified charitable distributions do. And so if you must take out, $12,000 this year, you could send, it doesn't have to be the whole amount, but you could send $6,000 to your church and you'd take home 6 yourself and you'd only pay taxes on 6,000 instead of all 12. Especially if you already give, right? Let's say you give $500 a month out of your Social Security check or your pension or whatever else, right? Stop doing that and pay it through a QCD instead. Because what that allows us to do then, let's say that you're trying to give $10,000 a year, right? But you're taking out of your other stuff. Well, you might actually have to earn $13,000 to then pay taxes on it to net $10,000 in the end to give to charity. But if instead you do qualified charitable distributions, well, then you can just either just give straight 10 and you can save the 3,000 yourself, or you can still take out the same 13 that you were doing before, and now you can give more. You can give up to 13,000 for the same impact on your own finances as it would have been before, or you can split the difference. And you might say, hey, I'm going to give 11,500 to charity, and I'm going to keep the extra 1,500 in tax savings. And that way I give more and I am impacted less by doing it this way. Critically, the age you need to do QCDs at is 70 and a half. So not 73, not 75. You only need to be this old. And that's because RMDs used to be this age. They've been kicking back the age for required minimum distributions, but they kept the QCD age the same. They like forgot about it or something. And so there are some people that are waiting around for their RMDs. They're not there yet, but they are over 70 and a half, or they will be this year. And you could switch your giving to QCDs instead. Okay. There's some other great points in this book about it. Again, if you have brokerage accounts, donor advised funds are covered in here. Tax deduction bundling is covered in here. We also talked some of that stuff about in the video, which again, linked in the description for that. So if you're charitably inclined, definitely check out that video, check out the book. And if we can give to Caesar what is his and to God what is God's, or to your charity what you want to give to them, and we can do more of it to the charity and less of it to the IRS, I think that's a great strategy. So that is number 5, charitable gifting strategies. And then lastly here, last strategy we'll cover today is legacy tax planning. What happens to all your money when you're gone, right? And this is something that most people don't think about, because we don't like to think about what's going to happen to us or our money when we die. But for a lot of you, so 2 things that I want to cover real quick. For a lot of you guys, if you're married, right, men don't live as long as women in general. And sometimes there's a decent age gap there. Like you might have a 3-year age gap and a 3-year difference in life expectancy, which means that she will outlive him by 3 to 6 years, right? And so what happens for a lot of people is, you've got these tax brackets, right? You got your 10% bracket, you've got your 12% tax bracket, you've got your 22, and you got your 24, 32, etc., right? So those are going out and everything's fine and dandy, right? But then one of you, usually him, but not always, passes away, right? And maybe this whole time your income is like you're just inside the 12% tax bracket, right? And you're like, hey, this is great, we're saving taxes. But then he passes away and you go down from married filing jointly tax rates to single tax rates. So all your tax rates get cut in half, and you go from being firmly in the 12% tax bracket to now we are firmly in the 22% tax bracket. And her taxes get doubled overnight, right? Or maybe you were in the 24% tax bracket, and now as those get cut in half, now you're in the 32, which isn't as big of a jump from a percentage basis, but it is still an 8% jump. And again, if she outlives him, if he's 3 years older and she's going to outlive him by 3 years by just age amount, it could be 5, 6, 10 years of her living in this lower tax bracket, same amount of money, right? Because your IRAs don't get cut in half. You might lose the Social Security, sure, but for the most part, like your money's still there. And so you have the same amount of money, half the tax rates, right? So that's what we call the widow tax, where, hey, you're a widow, you're all alone, and now you're paying twice as much tax as you were before. And so one tax planning thing you're going to want to do is to say, well, hey, if we know this is coming, especially if we think one person might significantly outlive the other, then it's going to increase probably the Roth conversion that we're going to want to do. It's going to increase the importance of Social Security tax planning, all these other things, so that one person isn't completely hosed in taxes down the line. Because again, if the goal is to pay the least amount of taxes over our lifetime, it might mean paying more now so that we pay less overall, right? So that's one thing you want to be is figure out, are we going to be subject to a widow tax? Again, anyone could be at any time, but do we have a high likelihood of that happening? And then also, right, at the end of all that, when we eventually pass away, we have all this money, we're paying a certain amount of taxes on it, both people pass away, they're gone, and now all that money all goes to the kids, right? And so you've got your big IRA that then goes to your kids, and they get an inherited IRA, and they have 10 years to pull all that money out, all at their highest tax rate, right? So they're trying to do all their own tax planning, and then they get a bunch of money from mom and dad. And so again, it's not just what are you paying, it's what is the next generation paying? What are the legacy taxes that we're going to owe on this? So it might be one of those things where you might say, well, hey, we can optimize for us being in a low tax bracket, but if we're looking at the next generation, if they're going to pay 22, 24, or 32% taxes on it, maybe we want to do more conversions at 22 so that our kids don't have to pay at 24 and 32, right? And so just knowing kind of where they're going to be, where you're going to be, how much you're going to pass on to the next generation, all those things are critical in this. And looking the other way, are you going to inherit something? Right? I don't know if I've ever had anyone come into my office and says, yeah, we don't have any money. We haven't really saved anything. We haven't had to because we're just waiting around for mom and dad to die so we can get our inheritance. Right? I don't tend to talk to those people. But for some of you, it's a reality, right? Your parents did do a good job. They're sitting on a bunch of stuff. They're sitting on an Apple stock from 30 years ago, right? And it's $1 million or whatever. And so like, are you going to inherit something? And are you going to have 10 years to take it out? And do we need to do tax planning for you to make sure you don't get hosed in taxes with next generation taxes? So it's not just your lifetime taxes we want to plan for, it's the legacy taxes going both directions. How do we, again, pay the least amount to the IRS, keep the most for you and yours? So there's 6 tax strategies. Avoid bad ones: Roth conversions, brokerage strategies, Social Security tax planning, charitable gifting strategies, legacy tax planning. All of that is covered in here. We also have done the videos on at least some of those topics, if not all of them individually. We just want to get good information out there. Way too many people are paying way too much in extra taxes. And if we take some time or hire someone competent to do it for us, then we'd all save a lot. So that's what we're trying to do here. So there we go. Okay. Next up, we have our new segment, our sketch segment, which we're going to call the Stay the Course sketch, in honor of the title of this first one. So again, I send out a weekly email. It comes out on Tuesdays. Ethan, when does it come out? Mondays. All right. I read a bunch. Ethan scheduled them out. Ethan, our producer, he's in the background here. He does a great job with all that. And so if you like written content, you want a short, ad-free, just boost to your overall planning, to just feeling good about what's going on, you can become a retired member. You get access to exclusive content. We send this stuff out. And so I decided, hey, why not repurpose some of those sketches that we've been using in the written email into the videos as well. So this one, right, stay the course. And the whole point of this, right, as it shows, is that, hey, the market, right, market's going to do what it's going to do. And there's all kinds of problems. There's all kinds of catastrophes, crises, whatever else. Inflation, war, you name it. Pandemics, right? Current one being war in Iran, all these things, all the political chaos that's going on with it. And all of it ultimately is a distraction to what you're trying to do, right? Market's going to do what it's going to do. And if we just stay the course, that's how we make the money, right? It's not by responding to every little thing. It's not by, hey, the market's down 4%. Should we be getting out? Should we rebalance it? Should we be doing something, right? 4% declines, 5% declines happen all the time. 10%, 20% declines happen all the time. You're not going to be able to successfully time getting in and out of the market. Again, you got to be right twice to be able to do that. And at the end of the day, especially with things like now, where we have a lot of economic or a lot of political turmoil and war and all this stuff, it's important to remember that at least if you're invested, if you're a client of ours, or you invest the way we do it, we don't invest in the government, right? So if you don't like the government, or maybe you do like who's in charge, but maybe you don't like what he's doing or whatever else, right? It's just fair to remember, like, we don't invest in the government. And now that's not true for everyone. There are a lot of people who are invested heavily in U.S. treasuries and government bonds and all this stuff, and we invest in the best businesses in the world, right? We're equity owners, business owners in the best businesses in the world. And so because of that, like, yes, what the government does impacts what we do, but we're not invested in Iran as a government. We're not invested in Israel or the U.S. as a government. We're invested in the best businesses. And those businesses employ the best people to figure out how to stay profitable and continue to develop and deliver the best services to us and to everyone else who buys them. And when those businesses long-term continue to thrive and make money, so do we. And so even though it can be uncomfortable sometimes to see the changes in our accounts, to see the negatives, to hear the news, which just makes us a little on edge, a little worried, staying the course really is the best way and the only way to build long-term wealth and security. And so my encouragement always is going to be stay the course. If you think this is helpful and you want more stuff like this, again, we send a weekly email, and that's probably the overall theme of my weekly emails, is just staying the course. Little sketches like this, little few hundred-word essays on just to kind of help encourage you. And so feel free to subscribe to that. I think there's probably a link in the description to become a retired member. Otherwise, you can go to retirementorship.com, and there's a link in there somewhere to become a retire member. So, okay, we're probably about as much time as I wanted to take today. One question we had was, when is your book coming out? Glad you asked, right? It's, again, Tax Saving Strategies comes out March 26th, 2026. So my first book came out 2/22/2022, and this one comes out 3/26/2026. And it's all about saving taxes, right? For your lifetime, long-term, and legacy taxes. So if that interests you, great. If you are watching this and it is Wednesday or Thursday, and or just during launch week, we have a whole bunch of awesome deals for ordering it right on launch day, ordering it in the first week or so. So check them out. Follow the link in the description. Go to retirementorship.com. See what's available to you. The earlier you order it, especially on launch day, the more you get. So we want to try to get it out there to as many people as possible and benefit as many people as possible. So thank you for ordering. Thank you for enjoying it. Thank you for tuning in today. Hopefully this was helpful. Quick overview of a lot of things we talk about more in the book. We'll be here like we always are every Wednesday, 4 p.m. Central Time. If you have questions, you can always comment in the YouTubes, and we will try to get to those questions in our Q&A time at the end of each episode. If you want to leave us comments or shoot us an email at questions@retirementorship.com, we can take those questions as well and turn them into segments of the show. So hope you enjoyed that. We'll see you next week. Cheers.